Hello, traders. Today's theme is sucked in. What do I mean by that? The market is setting up a trap right now, and I'm going to try and help you avoid it. First, let's take a look at our previous picks. So IBM was a pick that I showed you a week ago. It was a short that I was going to be evaluating. No reason to take action. We had lots of big news, and I'm going to get into that in just a moment. But we suspected that there could be some upside catalysts for the market. The market has been able to move higher. And when we have a short on our radar, I explained to you the types of things that we're going to be watching for. For IBM, I absolutely wanted to see this horizontal resistance level hold, which also came into play around the 100-day moving average, the blue line. That was 240. So as the market advanced, what did I want to see IBM do? I wanted to see it bump its head against that 100-day moving average, not able to get above it. The stock was able to move above it. In fact, it closed above the 50-day moving average on Friday. What does that mean? It means that this stock is no longer that attractive as a potential short. I could click here, I could click here, and that's going to draw an upward sloping trend line, and that will keep the stock on my radar. So why don't I do that right now? So as this upward sloping trend line extends, if the stock comes down and breaches it, I'll get an alert. Anytime that you see an attractive pattern setting up, you should set alerts. GTC, I'm going to click on the bottom of this wick. And look, now I've got an alert. If the stock happens to pull back below the 100-day moving average, I'm going to get an alert. That'll give me an opportunity to evaluate what the stock is doing relative to the market. I always want to see relative weakness in the stock. So on Wednesday, I gave you CELH. Let's take a look at that one. Again, we are only keeping stocks on our bearish watch list. We are not acting on them because we don't have the market weakness that we need to see. And so here you can see that the stock has been rolling over and it has not been able to rally with the market. Hover over the E and we see that earnings are going to be announced this Tuesday, May 6th. No reason to take a position, but the stock has been able to preserve its relative weakness. If the market had rolled over, this stock would have sold off. So I was very comfortable with that short position. Right now, you should not have any position in CELH. If you do have one, make sure that you close it down before that earnings announcement. So let's take a look at the market. And before I get into today's current condition, I want to take a look at what happened during 2022. So you can see that the market gradually starts to roll over in January. It takes quite a while before the 50-day moving average crosses over the 200-day moving average. When that happens, we have what's called a death cross. That is the sign that conditions are changing and that we are now in a bearish cycle. But look what happened once we had that death cross. We had the market rallying through the 200-day moving average. It even got through the 100-day moving average. Hey, everybody, look, it's all fine. Jump back in the water. It's fine. It's warm. No problem here. That didn't last very long. And look at how the market sold off. Oh, but Pete, you're just picking one example from 2022. That's 3 years ago, and it was just one example. Trust me, when the 50-day moving average crosses below the 200-day moving average, it's noteworthy. It tells us that on a longer-term basis, we are in a bearish market cycle, and that bounces will eventually hit resistance and they are to be faded. So if we fast forward and we go to what the market's been doing over the course of the last 2 or 3 weeks, we can see a similar pattern. And here you'll see big drop, 50-day moving average crosses below the 200-day moving average. You'll also notice that the market is above the 50-day moving average and it's very close to the 200-day and the 100-day moving average. So for the average trader who might look at this and they're thinking, Gosh, Pete, you really didn't participate in that market rally the last week. No, I didn't. I didn't know what the outcome was going to be. I didn't know how ugly the earnings were going to be. I knew that the tariffs had not taken effect and that the earnings were probably going to be pretty decent and that there is a lot of fear built up. Right now, the market is trading off of tariff news and it's ignoring the real issue, which is the global macro backdrop. Global conditions are deteriorating. Okay, that is the problem. Tariffs are simply going to push us over the edge a little bit sooner. So I am not bullish. I'm still bearish. I am still in waiting mode, and I'm waiting for the market to reach as high as it possibly can go, and then to struggle to advance through these resistance levels. As soon as I see that, I'm going to be looking for stocks that have not been able to rally with the market. Why is that so important? Because there are sellers out there. They are out there selling the stock. They're keeping a lid on the stock. They're trying to exit as much of the stock as they can when market conditions are conducive and when the market is still moving everything higher. There's a good bid, but they are unloading shares of stock, and that's why it can't advance with the market. That tells me that there's relative weakness, and as soon as the market hits resistance, those stocks are going to crumble. What's the other side of that coin? The other side is that as the market continues to move higher, these stocks are not going to participate to any great extent because the selling pressure is so heavy. Those are the tells. That's what we're looking for. That's how all of this works. So, first of all, I'm not going to get sucked in. Hey, look at this market bounce. This is great. You know what? We're going to get some trade deals real soon. Trump is telling us there are going to be trade deals real soon. Okay, well, what does real soon mean? Is that 2 weeks from now? Is that a month from now? Is that 2 months from now? We don't know. But what I can tell you is that those trade deals are going to have a 10% tariff base. He's been firm on that across the board. He sees this as a way of generating revenue, generating income, and it's a way to incentivize corporations to build out their manufacturing and production facilities in the United States. That is his plan. Without the 10% tariff base, there's no incentive for companies to do that. He's also going to be cutting taxes for companies in the US. Okay, that's another incentive. But all of these things are going to take a long time to play out. In the meantime, what we're seeing in China is all of these container ships are starting to stack up everywhere in China. And I believe that shipping traffic is down about 35% year over year, just based on normal traffic during the course of the last month since the tariffs have been imposed. China, they say that they're ready to talk, but they haven't been truly engaged in the process, versus the U.S. is saying, oh yeah, we've been in constant talks with them. Maybe this is just political posturing. I don't know. I really don't care. What I do know is that the base 10% tariffs are going to have an impact. And even with all the other countries that are negotiating tariffs right now, they're still going to pay the 10% basis. And there are going to be some retaliatory tariffs on top of that. This is going to cause some supply disruptions. But again, I'm not that concerned about the tariffs. I'm much more concerned with what I see on the global growth front. And this is definitely going to hurt China's numbers. Now, mind you, they might not produce a widget all year, but their GDP, it's going to come in above 5%, just like Xi promised. So you can't trust their numbers at all. But what you can do is you can look at companies who are doing business in China. They have to disclose what their revenues are in China, and that's where you can start to see some real weakness. So what else do we have going on in the economy? Well, we had our first quarter of negative growth. Okay, well, some people are saying, well, it wasn't quite as bad as we thought it could be, so it's actually kind of a positive. And we have other people saying, well, maybe the Fed is going to be in a more dovish mode come Wednesday, because this Wednesday we have the FOMC statement. The Fed's been hawkish. The way I look at it is they want to preserve job growth. Jobs came in very strong, 177,000 on Friday. It's a good number. We also had wage growth of 0.2%, which is also good because that means that that's the largest input cost for manufacturers, and that we're not seeing a big spike in input costs, which would be inflationary. So that was another good component within the jobs report. ADP processes private sector payrolls, and there we've seen actually a pretty big drop off in employment. We also had the initial jobless claims number came out at 243,000, I believe, this week. That was a nice little pop. So we're starting to see a little bit of weakness on the job front. And so what other economic news do we have this week? Not much, really. We've got mainly the FOMC statement that's going to come out. I don't see them changing their posture very much. They've already said we're happy with current policy. Everyone is expecting a 25 basis point rate cut in June. We'll see if that's still in the cards based on what the Fed says this Wednesday. And if it's in the cards, great. I think that the market's already priced that in. There's about a 93% probability of that happening. So we'll see how the May news is received by the market. I'm going to be watching for resistance, resistance, resistance right at these major moving averages. But Pete, the market's bounced so high. What if we get a trade deal done? What if Congress passes the budget? I'm hearing that that could be a month away or so, and that's certainly positive. I think the market's going to eventually find that resistance level, and it's going to roll over because all the news that's weighing on it is going to finally culminate, and then you're going to have people focusing on the fact that, yes, growth in the U.S. is starting to slow considerably, and that tariffs aren't helping matters at all. In fact, they're creating some problems. So there is short-term pain, and I believe that Trump recognizes that this is very, very possible. But in order to get his agenda implemented, you got to go through a little pain first. So the market's not looking for that. It's just looking at this nice, big, tall mounts. So what are we going to be doing, and how are we going to be positioning ourselves? Well, there's an opportunity for us to make some money day trading from the long side as the market searches for that resistance level. How do I see this possibly playing out? What you have to be very careful of in here is any big gap up. Okay, a gap up to a new relative high, especially to a major resistance level, is likely to get spanked down instantly. And that's where you could see a gap reversal that leads to a bearish trend day with a close on the low. Very heavy volume. That's what I'm going to be looking for as my sign that, aha, now we have resistance. Why else might I possibly be so bearish right now? Well, if you look at the volume, big volume here during the decline, big volume here during decline. What have we seen during this rally? Not a lot of volume. There's not a lot of market participation. Very gappy moves. When you have gaps like this, gaps like this, gaps like this, there's not a lot of participation because asset managers don't want to chase. They're much more interested in buying pullbacks, and that's one of the reasons that the level of conviction has been fairly low. I believe that they also recognize that this big drop that we had right here, that was a 20% drop from the high, that this is not a fluke. There are some major concerns going on globally, and we've seen currency fluctuations all over the board, and we've seen bond fluctuations all over the board. These are warning signs. So just because this bounce has lasted a little bit longer than we might have expected, just because it's rallied a little bit higher than we might have expected, that doesn't mean that we instantly flip the switch and go, oh, we're in bullish mode. We're going to rally straight back up to the all-time high and keep right on going. That's not the backdrop that we have right now. And what happens when you shift like that is that you gather all your information, you form a market bias, and then all of a sudden, just on a whim, just because the price movement has moved a little bit higher than you thought, you start changing your mentality. And now all of a sudden it's like, oh, back here I was looking to add to short positions. I'm glad I didn't do that. I'm glad I waited for the bounce. So you're patient, you're diligent, you're doing all the right things. And then you're expecting this resistance level to hold like a brick wall, and it doesn't. We start poking through. So you're already kind of changing your mind. And then now you get follow through and you're thinking, oh my gosh, I'm missing this move right in here. Look at this. The market's going without me. It's going to keep going and going. And now all of a sudden you start entertaining thoughts of maybe I was wrong and maybe I was bullish. So now you start taking long bullish positions and you start loading up in here thinking that, we're going to test these major moving averages and we're going to blow right through them. And then I'll be adding to my positions. Well, as you get up to those major resistance levels, what happens? All of a sudden, the market rolls over and the rug gets pulled out from under you. And now you are completely twisted because your bearish thesis, which you had originally, was correct, and you left the door open to start entertaining that maybe you should be bullish, and then you start taking those positions and the market does what you originally thought it would do, and it rolls over, and now you're caught with losses because you got cute. I've been encouraging you to wait patiently for your bearish opportunities, okay? That's where you need to be right now. Don't get cute on a day trading basis. Sure, in, out, in, out. Take your profits, hit and run. Sure, those have been great opportunities. And when we're super short-term traders, we can do that. That's one of the advantages of being a short-term trader, is you can take advantage of these bounces right in here. But on a longer-term basis, on a swing basis, you never want to get cute trying to buy these bounces. You want to stay steadfast and you want to monitor which stocks are not participating in the market bounce, because as soon as a market finds resistance, those stocks are going to tank. The bottom is going to fall out, and those are going to be your best shorting opportunities. So what do you do when the market keeps defying gravity and it keeps inching its way higher? You set alerts. You keep looking every single day for those weakest stocks, and you keep setting your alerts. And as the market continues to float higher and inch its way higher, you want to see those stocks hitting resistance and not advancing at all. There's firm support there. Asset managers are looking to reduce their positions in those stocks. So that's what we're going to be doing today. That means that this week, the pick that I show you, you may never trade it for another 2 or 3 weeks. And in 2 or 3 weeks, if the market continues to move higher and that stock does what IBM did and it continues to chug higher and get through technical resistance levels, you're not that interested in it anymore. Okay, you can still set alerts on it, but you can find other candidates that are weak relative to the market, so your focus starts to shift. But if that FOMC statement comes out and there's a bearish market reaction to it, I want to give you some shorts that you should be keeping an eye on so that you know where to look for opportunity. The other thing that I'll mention is that right now, after this nice big tall rally, we've come from 480 to about 570. That's a huge rally. That's about a 900-point S&P rally. And you're not going to be able to find a lot of great stocks in the stock searches because the positive momentum has been carrying all ships higher with the tide. So that means you're not going to see a lot of prospects initially. And even when we do hit that resistance, it's not like, okay, we gapped up and we got one bearish engulfing candle, one bearish reversal off of a new relative high. Boom, that's it, I'm all in. Now we're going to still need some price confirmation. And then what I'll be looking for, could you initiate some overnight short positions if we see that pattern? Yes, absolutely. But what we'll be looking for is immediate follow through, like the very next day. And you want to see a long red candle that takes out the 50-day moving average. And we want to quickly take out this horizontal support at the 550 level on the SPY. If you get that kind of price action, you know that sellers are back in force and that the market is ready to roll over and perhaps test that 480 level. When is this all going to play out? I don't know. All I know is that I consider this to be a wimpy, fluffy bounce with light volume. I know that global economic conditions are continuing to be soft. I know that the Fed has continued to be very hawkish and that resistance is going to be established probably within the next 2 or 3 weeks. And if we get into July and we still haven't seen it, I'm not going to fret because I know what's happening on a global basis. So I am not ready to just flip-flop and go, okay, I throw in the towel, I'm bullish now. It's not going to happen because I see trouble ahead. This was not a mistake. And while I'm waiting, there's something that is going to help me, and that is that volatility, option implied volatility, is starting to collapse. And so as VIX and VXX continue to decline, that's good for me because ultimately I would like to buy some in-the-money puts and I want those option premiums to be as cheap as possible. So waiting patiently for my opportunity to set up is only giving me a better entry point in terms of price level and in terms of option implied volatility. So when you trade, you've got to know which side of the market you're favoring and why. And then you've got to be looking for constant signs that perhaps your thesis is wrong. Perhaps the moves are still within the realm of possibilities that you had already expected. This bounce is certainly within the realm of possibility as far as I'm concerned. And we could even poke up above the 200-day moving average very briefly, but I wouldn't want to get through the 200-day and the 100-day very quickly. Then all of a sudden I've got to start thinking that maybe there's something bigger going on behind the scenes. I really would put that probability at maybe 10 to 15% probability, no more than that. But now that mega cap tech companies have announced earnings, I believe that we're going to start to see some of that softness because shorts do not like to be bearish ahead of these mega cap tech earnings because that's what's been leading the market rally. So there's a lot of risk to being short ahead of those big earnings announcements. Mind you, the tariffs really haven't even been implemented during Q1. All the results for Q1, they don't even show those numbers because those quarterly reports and that quarter ends before the tariffs were even enacted. So even the 10% component part of it and the rest of them have been postponed. So they really didn't impact earnings at all this quarter. They came out better than we thought. The other thing that's playing out behind the scenes and that is going to start rearing its ugly head is the fact that lots of inventories have been built up right now. So as soon as Trump is elected, companies ordered as much as they possibly could to try and front run those tariffs to get those goods imported so that they wouldn't have to raise prices right away. Well, that means that they're sitting on a lot of inventory, and that means that that inventory has to get worked off. And right here, right now, you're seeing production levels decline because you've got this inventory buildup. That has yet to play out. But it is going to play out this summer. And when the market does hit that resistance level, your next good swing trading opportunity is going to be on the short side. I'm very firm about that. And I'm just simply waiting for the opportunity to set up. A lot of traders, they feel like they've got to catch every single move. And I'm telling you that if you wait for the right moments and you wait for proof that your thesis is still intact, you're going to be able to enter trades very effectively and then add to those positions. I'm waiting. So that's where I stand personally. Day trading, sure, you can catch a little bit of this upside. Just make sure that you don't overstay your welcome. When I take a look at all the stocks that announced earnings, in particular the mega cap tech earnings, Apple to me looks like a great short. Now, it's in every single index. It's the largest capitalization stock. So if the market goes up, it has to participate because there are going to be index funds that have to buy the stock. And when you see the stock struggling like this, you can see this big drop, and you can see how Apple has been struggling to try and get through AVWAP-E. Well, now it's announced earnings last week, and you can see that the stock dropped on Friday. So even when the market was in go-go rally mode all day on that jobs number, what did Apple do post-earnings? Big sell-off, couldn't get off the deck. And that was even with a nice big market rally. That was even with institutions having to buy Apple because it's in the S&P 500. I'm going to be watching for this continued resistance around the 50-day moving average. And as the market moves higher, I want to see, so let's say the market tests the 200-day moving average or even the 100-day moving average. What do I want to see out of Apple? I want to see that 50-day moving average hold, and I want to see it struggle to advance. If I see that type of price action on Apple, I'm going to know that it's going to be one of the top shorts that I have on my list, so that when I get that nice big lift off in the market and that gap reversal, Apple's going to be one of the first stocks I look to because I can already see the selling pressure in advance. Pete, should I buy Apple puts tomorrow? Because what if the market rolls over on the Fed announcement? No, you should not do that. Okay, so we've got to wait patiently to see what happens with the FOMC statement. Oftentimes the initial reaction is faded the next day and it reverses. So no, we want to wait. This is the early stages of starting to build a bearish position again. So we need that confirmation that resistance is in place. Just like I said before, one day alone is not enough. We need to see follow through once we have that short-term top. So we want to see selling after that consistently. If we start getting that, then you add a short position in Apple, and as you get confirmation and the market continues to roll over and show weakness, you want to see the same thing in Apple. You continue to add to the position. You build the position gradually, and you do it from a winning position, meaning your average cost for your puts, for instance, is much lower than the current price of the puts. That's what allows you to add to a winning position because you have price confirmation from the market and you have price confirmation from the stock, and then you just continue to gradually add to the position, and you see what the market does when it tests each one of these support levels. So 550, blam, we want to blow through it. The next support level, it's probably going to take a little bit longer to get through, but it will be AVWAP-Q will be your next support level. And then, yeah, you want to see that crack down, start seeing some long red candles. That tells you that, yes, now you're in adding mode for an Apple short as long as it is showing signs of relative weakness. So this is how we need to trade. I know that a lot of you are antsy. You're thinking, my God, maybe we got this whole thing wrong. Look, the market's actually looking pretty good. Draw a downward sloping trend line. Look, we breached that. We breached through this horizontal resistance low. We got above the 50-day moving average. We're going to go up to the 200-day moving average. We're going to get through the 100-day moving average, and then trouble is going to go to the new all-time high. Take a deep breath. This is legitimate, and we are going to start to see some resistance in here, and it's all about the global backdrop. That's where the weakness is going to come from, and that's what's going to cause our economy to gradually falter. And the tariffs are not going to help matters. That's what I'm looking for. If you feel that this content has helped you, please give it a thumbs up. Only day trade from the long side. Do not swing trade from the long side. Know that your opportunity and your window are going to set up. And if you keep watching these videos and you turn on your notifications, you're going to know where I stand every step during the process, and you'll be able to catch that move when it finally does happen. Thanks so much for watching. I'm going to do some short videos through the course of the week, so make sure you got your notifications on so that you know how I'm trading those. Thanks. Trade well.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.